I'd like to begin by thanking both Yixin as well as John for being here today for a conversation that will focus on one aspect of the private credit ecosystem that has come under increasing scrutiny, which is retail investors. And I want to start because you two are both combining your efforts to create retail-focused funds, ETFs, that are backed by the credit markets and private credit in particular. Can you just start by saying how complicated this moment has made that effort, based on the fact that that seems to be sort of, I don't know, boogeyman number one?
Well, we got started working together, 3 years ago, before we launched our very first ETF, about a year ago, actually. And because we're such a large ETF issuer, we care so much about liquidity, transparency, efficiency. I mean, that is what the vehicle is all about. And so a lot of that work has been working with Apollo in terms of not only sourcing the investment-grade private credit, but also the intraday liquidity. And one of the most fascinating things is in the course of this year, as we've provided transparency to the underlying, we're finding other parties interested in making a market. And so it's very early days, but I think private credit is not just one big asset class, and we focus really on the investment-grade side, where it makes sense that that liquidity would start to show up.
It's great because it gives us a moment really to differentiate between sub-investment grade credit, which is the tiny slice of the $40 trillion market but gets 95% of the press, and the investment grade side of the
Feel targeted.
Yeah, right. Exactly. To 95% of the business, which is, providing very large investment grade deals for, you name it. We've done 50 transactions in the last 24 months. Intel, BP, Air France, RWE, EDF, multi-billion-dollar transactions that are on, in some cases, 100, 200, 500 billion-dollar market cap companies. And it's just a totally different risk profile. And just because it's privately originated or privately structured, it gets put into the same bucket as, sub-investment grade, mezzanine lending in some cases.
I guess that right now there's a fear of what isn't known. And there's a question about why something would get financed in the private markets, which traditionally was a more leveraged finance asset class. Why would it be financed in the private markets when they could have gone to the public markets, right? So what is the value proposition offered to retail investors by going and getting access to private markets?
Yeah, we're in this unique time where we need multiple trillions of dollars in the US, multiple $1 trillion in Europe, Asia as well. All the AI stuff, spend from power, infrastructure, chips, everything requires a very bespoke, long duration that's not traditional to the CUSIP market. And so if you want to work with somebody and actually commit 10, 15, $20 billion over the next 10, 15 years, you really need insurance and retirement type long duration capital to match with that. And historically, the capital markets was just equity and debt. And the scale and size of the need is so large that you have to access different markets. So it doesn't mean we're only going to do private markets. It means, hey, you may have, AT&T did a pref with us, $2 billion. You have $140 billion of debt. Because they did $2 billion of private debt to diversify, to have a different ecosystem to have access to have a different funding source in times of dislocation, does that mean that $2 billion of over $100 billion of outstanding debt is risky? Yeah, exactly. So it's like, it is, I joke internally, unless, Claude and AI figured out a way to make private credit riskier in some way, and some way that I missed or something, or that it made credit junior to equity. I haven't figured that out yet, but if it figured it out, I guess that's a different type of risk, but I don't think that's happening anytime soon.
Well, Yixin, from the perspective of the retail investor, what then is the value proposition if it's the same debt, just in a different name, right? Is it, traditionally, it offered more yield. Does it still have to?
I think it still does. And if you look at, we've now, are in the process, we've launched 2, we have another one that's coming. And it's a combination of public and private debt, so it's not 100% private credit. And in many respects, the use cases are actually quite a number for both institutional investors as well as retail investors. And in fact, our very first ETF, it really competes in sort of the investment grade core plus category. And if you think about plus, most investors or most managers have delivered either high yield or emerging markets debt as that plus piece. Whereas in this case, we're really talking about that yield premium you get in the private markets. And so you've seen it over the course of the year in terms of the relative performance of this vehicle. And so it does give investors, retail investors, some exposure to an asset class they might not otherwise get, but it also makes sense for institutions. You know, that it is an alternative way of delivering that sort of exposure. And if they're sitting on cash ready, waiting to put that to work, this is a good place to be housing those assets.
So if I were listening to what you guys were saying, I'm like, what is this about cockroaches and people doing dumb stuff? You could go up here, well, it's a typical instrument tied to AT&T. I mean, what do you make of the discussion around what we're seeing in non-investment grade debt, potentially debt tied to software, potentially debt that was underwriting with less stringent standards than you may like to see? I mean, what do you see unfolding right now in private markets? How would you characterize it?
Yeah, I mean, in our product, we do zero. It's 100% investment grade. So the reason we're focused on the investment grade side is really what we've partnered on has been none of what's been in the press, but still gets put into the private credit bucket. We've been, you know, I got into credit to actually be out of the press and actually be a pretty boring business, and apparently it is the most exciting business on the planet.
I'm sorry.
Doing senior lending against large companies is apparently extremely exciting. So we have to talk about it a bit more than I expected. Clearly, we're going through a technology cycle and a platform shift in the world that and people typically don't like change. And so when you go through a platform shift in the way that most businesses are going to operate and most things, there's going to be some level of disruption. And in this case, clearly the eye of the storm is software. And just like in almost every other cycle, I'd like to say that what I'm saying is new. It's not that new. MLPs had a really hard time in energy crisis. Any sector that goes through a platform shift, if you're overexposed, asset managers in that feel tremendous amounts of pain, and you get exposed on the risk management side. And that's kind of what's happening, I think. It's early days. If the software, if the technology keeps getting better, I suspect it will not just be software, it will be services and other sectors that will get exposed. And one thing that's being missed by the private markets is we're doing stuff and funding the next 10, 15, 20 best companies in the world. Like it's not just all bad. We're funding $10 billion for SpaceX in terms of GPUs. We're funding Intel's fab. We're funding Databricks. Like you talk about the single best companies that are being formed, and there'll be 10, 15 new $1 trillion companies. Credit is the centerpiece of that. And growth investing is going balance sheet heavy because you need all this infrastructure, manufacturing, robotics. You're going to need so much credit. And all of these growth businesses finance themselves with pure equity their whole life. And so I think the exciting part about it, I mean, again, the negative is obviously what it disrupts. But the exciting thing is that growth investing is going to be a balance sheet heavy business. And credit and private markets is going to be the financier for all these great companies.
I love it. When I talk to equity guys, they're like, oh, the problem is it's becoming asset heavy. And you talk to the credit guys, they're saying the nice thing is they're becoming credit heavy. Yixin, from your perspective, I mean, do you see this as being an isolated kind of MLP-like disruption, the idea that you could see one asset class, one industry affected? Or do you think that this could potentially have the nodes of something a bit more systemic?
You know, I think you have to step back from just private credit, right? I mean, AI is such a transformative technology, and we're seeing it in terms of, you know, impacting different sectors. There's going to be winners and losers, which companies adopt it in a very meaningful way to establish competitive advantage, and which are going to be slow to doing that. And so it's a tougher environment, I think, to be investing. Like John, I think private credit's going to be here for a long time because the needs for debt financing are not going to go away, and it's not clear the banks are going to be in a position to provide that type of lending. But it's a time where diversification really matters a lot, thinking about what are the implications as we move forward. And so, you know, having a broad-based exposure, whether it's in private credit or in equities or whatever sector, is really important.
I've been surprised by the isolation of just private credit. I think there's still a complete misunderstanding of what that represents in the economy, meaning 8,000 private companies, broadly diversified. Obviously, some asset managers more than others, but if the private credit market goes through, as UBS said, a 15% default rate, the idea that the public high yield market, the public equity market, all these public markets would be completely fine while the entire private debt market melts, the likelihood of that is extremely, extremely low. And it's been interesting to see how the public markets will say that this will have a very big problem, but everything else will be fine.
Do you reject that type of assessment by Matt Mish over at UBS?
Listen, I think if you read the piece, it was a little bit taken out of context. I think it was kind of his severe bear case, and there's some probability that that can happen. And again, anybody can go out and say that the tail looks like this, and it could. But to say that it will only happen there and that we shouldn't be worried about all these other markets, when in fact we're senior debt on all these other markets, that, again, not really logic behind that, but for whatever reason, it's definitely the story of the day.
Well, there are two ways to look at this. The first way to look at this is that people are overly penalizing private debt and saying that there is an overemphasis on underwriting standards that are weak, et cetera, and that there'll be just a right sizing, and you'll see some of those marks come back if the marks ever were there. On the flip side, you could take a look at this and say, actually, people aren't recognizing that there is deep pain to be had, that this washout is going to be much deeper, and it is going to be representative of a larger credit cycle throughout all asset classes. Where do you sit on that?
Again, I am more in the camp that the next 12 to 18 months are going to probably be more difficult. There'll be more dispersion. And again, when we're going through a platform shift at the core foundation of how things operate, that's a really difficult time typically for many companies. Not all companies, but many companies. And so the way to protect from that is be diversified, be senior, be income oriented. So I think a lot of the things that represent why people get into private credit, which is to de-risk, be safer, go senior, it's kind of getting lost with the fact that obviously 30% of that market was software oriented and is really center of the storm. So I'm probably more of the camp that we have a tough 12, 18 months ahead of us, but there'll be clear dispersion coming, and so it'll be interesting to see.
I think we're going to see a lot of signals from the public markets, frankly, because these same issues, whether AI is going to really impact the software business, any other sector, I mean, that's going to be coming through as investors are worried about the impact on different companies. So I'm sort of with John. I mean, I don't think of private credit as being like by itself. It's part of a broader ecosystem. And I still think we're early days. I mean, there's different theses around, okay, what's the impact? I mean, some software companies may argue that they've got really enterprise integrated models that are incredibly important. The data is valuable. And so where this ultimately settles out, I think time will tell. As we think about different sectors that look like in 2026, we're going to see an ROI from AI is probably healthcare technology or manufacturing, energy discovery, but it's not broad brushed. I think there's a lot of companies obviously embracing it, but then figuring out where does that really move the lever in terms of returns or risks, I think are still to be played out.
This morning on Bloomberg Surveillance, we were talking about how there are these three major risks right now that seem to be buffeting markets. On one hand, you have the question of AI transformation. On the other hand, you've got questions of these pockets of risks that are emerging in private credit. Yes, private credit, but also particularly tied to software and particularly tied to a couple of specific funds. And then you have this third thing thrown in the mix over the past 5 days, which is an oil price shock, which could potentially increase inflation risks, reduce the chance of the Fed cutting rates. At what point does a tightening in financial conditions tied to that type of exogenous shock sort of preempt, escalate, accelerate any kind of credit cycle that you see coming through the pike as a result of the fact, A, we haven't had one in a long time, and B, the fact that there is going to be a lot of change and people don't like change?
Yeah, I think the question is going to be sustainability of what's going on in the last 5 days. The longer it goes, the more it will be priced into markets, but for now it's been somewhat mute in terms of long end. In AI transformation, I think the big question is not whether or not it will make people more efficient. It will be how efficient does it make people, how efficient does it really make people, and what will happen to the labor market in that, and what really happens to the consumer on the back of that, because that has been the big pivot. You know, you've seen some pretty severe headlines from a change in the forward labor market. That I think that's really the big question for markets, and how strong the consumer holds up. We're coming into this with 30 trillion of home equity, so it's a very different backdrop than 2008. So pretty strong in terms of overall balance sheet, but clearly, I think consumer confidence is in the early to mid innings of actually slowing, and I think that will probably start to show up in the numbers on a go-forward basis.
Yeah. I mean, time will tell, right? I think the market's reacting to every headline as it comes across, trying to read how long is this conflict going to last. And the longer it does last, the impact to oil production and energy transport could translate in terms of higher inflation or longer period of time. But our view still remains that, you know, it's a K-shaped economy here in the U.S., and that the lower income populations is where you're seeing lower wage growth, increased delinquencies, unaffordability. And so we still believe that, you know, the Fed should be in a position to be cutting rates rather than hiking rates, but it may take longer for that cycle to begin as we see what plays out.
Given all of the potential shocks, we were just speaking with Talon Pillay of Temasek, and he was saying, you know, for about a decade, they had an illiquidity premium. They wanted to be involved in private markets. And recently, because of all of the shifts, they've said that there's a liquidity premium. I'd be curious what you think about that, given the fact that retail investors tend to look for that liquidity premium, right? I mean, that's the reason why they're going into private markets through an ETF. I mean, do you see there as being a dissonance right now between retail investors' appetites and the reality of a pretty complicated world?
Well, I think the environment we've been in has shifted quite a bit, right? That's an understatement. I mean, fundamentally, you have so much value creation happening in the private markets. If you think about companies with 100 million more of revenue, 85% of them are private. And so you look at overall individual portfolios and allocations to alternatives, whether it's private credit, private equity, real estate, is very low single digits. You know, on the other hand, institutional investors have had very large allocations. And depending on your horizon, right, there's logic for these assets to be within individual portfolios. Now, I think this is where asset allocation comes into play, right? And we think it's a good thing that model portfolios have been growing, thinking about where does private markets belong within a portfolio. It should not be in that sleeve, which is your liquidity need. It should be fulfilled by other parts of that portfolio. So it's an evolution, I think. Longer term, still bullish on the asset class. But at the same time, I think it's really important that individuals, especially those that are thinking about these asset classes, are thinking about where's the right context for them.
I mean, we've set up our business because, I mean, we invest half our balance sheet with our own balance sheet, and we don't say put $1 in private and put $1 in public. We just say put $2 in credit. And the markets between private and public are moving so quickly. The ability to actually asset allocate from the outside without being able to assess, okay, are the private markets better today versus the public markets, or where should this private asset price based on this public markets? The whole industry has been built siloed. And we're trying to bring that back together, where it's just, okay, invest in the best credit assets that generate the best income orientation and the best risk reward, and not make it about private or public. And that, I think we're still in the early innings of that, but the market structure, the asset management structure, the product design, the delivery mechanisms, all of those things are going down a path of much more asset class focused and private public agnostic. And again, that's a big change, but I feel like this is forcing it. It's forcing all of this to become one.
Do you think that the Blue Owl issues and of late the Blackstone issues are creating a challenge for creating those dual ecosystems of liquidity, given the fact that, I believe 25 Blackstone partners contributed $150 million to help with the redemptions of 7.5% of a particular fund.
Yeah, again, you describe them as issues. I don't think they're having issues. I think they're making decisions on how to meet their client needs, and everybody has a different client set and a different view of exactly how they want to approach that, and they did what was, in their view, the best interest for the client. These products in private markets have historically been built in closed-end and drawdown funds, and now they're in quarterly liquid funds. And you have to have first principles about how you want to treat each client. And so I'm hopeful that this is an experience for all of us to make sure we treat our existing clients as fairly as possible in the moment, but also acknowledging that we don't know what next quarter or the following quarter is going to look like. And so we have to make sure that we treat everybody fairly. But I think going through this, and it happened in the real estate business for a while, going through this I actually think is going to be great for the industry.
Hold on a second. You can answer in 1 second, but I want to press you on something. I know you're like, please don't.
She waited till 2.5 minutes to ask me this question. she waited till the end.
What do you mean by treat fairly?
No, listen, when money's coming in and out, there is always the question of, okay, what's it going to look like next quarter and what's going to happen in the world, and there's lots of variables. For anyone to say they know exactly what the world's going to look like in 3 or 6 months, you have to look forward and say, okay, are we doing what's in the best interest of our clients and the long-term experience of the clients over time, and is it consistent with exactly what we said we would do at the beginning? And all of those, it's just critical that the industry does that. And listen, the people who are really big in this industry have been doing this a really long time, and they're really big for a reason. And so I'm hopeful that this experience, no matter how long it lasts, actually brings more confidence to the industry, at least to the people who behave appropriately.
And I think we already were seeing with these interval funds, BDCs, an increasing move to daily marks, much more transparency. I mean, in many respects, that's what was front of mind for us when we built our products together, was to make sure that that visibility was there for investors. And I think that, some of those aspects that you get in the public markets probably do find their way into some of these vehicles. And perhaps that is, one takeaway from this experience.
My final question is, coming into the year, there was a lot of discussion about how retail appetite for private credit was significant and growing because of certain regulatory backdrops. Has this episode changed that at all?
I think, look, long term, where retirees are growing at a very fast pace. It's not going to peak. Retirees in the U.S. are not going to peak until, I don't know, depending on your numbers, 2055. So you're going to have more retirees, and the baseline is that retirees are going to want to de-risk, which is historically to go into more income and more credit. And at the same time, you have an AI boom going on where you need $4 trillion of new money that's super long duration that matches exactly with the retirees' expectations and return stream. So the broad high level is highly likely that credit allocations go up. The question is, what's the delivery mechanism? What do people want? Do they want private IG? Do they just want credit? I think that's still getting figured out, but you're going to have to be you're going to have high amounts of adaptability to actually win. But I think credit allocations over time are going to go up just by the math.
I think that's right. Demographics would suggest that that is the case.